Hey everyone, Logan Hertz here with Hazeltine LLC. Today we're going a bit deeper into velocity banking, which is one of the strategies we talk about. It's a great complement to infinite banking, and I love talking about using velocity banking and infinite banking in conjunction with each other. We're going to start with the basics. So, velocity banking can make use of a first lien HELOC, and the all in one loan is an example of a first lien HELOC. And we have with us today a couple of guys who can talk with us about their all in one loan product and how it works. And then we can get into some more advanced strategies about how real estate investors can use the all in one loan to dramatically improve their results. So let's start with some introductions. So today we've got Harrison George and Greg Conley. Harrison, you want to quickly introduce your team?
Yeah, of course. Thanks, obviously, for having us on this channel, Logo. I really
Of course,
appreciate
sure.
that. So, want to just give you a little bit of background. So, Greg and I are on a team. He's my business partner. We work together at a company called CMG. CMG is the largest privately held mortgage company in the United States. We have about 3,800 employees, and we do about two plus billion in residential financing every month. Now, that's not just this unique all-in-one loan. That's conforming, obviously conventional FHA, VA, all the other stuff. And above and beyond, we have more unique products that I think Greg's going to get into in a little bit about the DSCR and potentially reverse bridge loans and some other unique solutions. One of the products, obviously, that is super impactful for this velocity and infinite banking is that all in one loan that we created back in 2006. It was named something different back then, but realistically, kind of a quick little breakdown on this product. At the end of the day, it's a first position home equity line of credit that can be done on not just a primary residence. It can be done on a investment and a second home. You can do it as a purchase or a refinance. But for a standard use case on primary residence, this product is a line of credit of up to 80% of the value of the home. So you have a $500,000 home, you get access to a line of credit of $400,000. If you happen to owe $150,000, the difference between what you owe and that line of credit amount is what your liquid access is. In this case, 250 grand. Now, the unique thing about this product is that it's a checking account paired with this mortgage. So instead of your paychecks going into your local credit union that you bank with or Wells Fargo or any of the large entities out there, your income actually gets applied 100% to your mortgage balance because you're depositing it no longer at that institution, you're depositing it at the new institution. So if you earned $10,000 after taxes into your bank account, that money would actually get applied 100% to your mortgage balance. No longer owing 150, you actually now owe 140,000. And the moment that you earn that money, your payment is now calculated off of the reduced balance, which allows for an individual without even really trying to save interest by just earning their money. Now, the other side of the coin is that you have bills, groceries, gas, diapers, dinners, whatever. At the end of the day, you go and pay your bills off. And when you pull that money out of the account, whether that's $7,000, yes, your mortgage balance does go up 7,000 from 140 to 147, but you're still $3,000 lower than where you started that month at. And you can kind of see where if you were able to save 3,000 ish dollars on a monthly basis, you can see how your mortgage balance is going to drastically decrease. But as it decreases, your payment goes down. So you're creating this even miniature snowball of money accumulation that expedites exponentially how fast you pay off your home, which works really well with whether you go into a whole life policy, which I think touched base on quite a few times, and additionally going into additional rental properties.
Yeah. So velocity banking, to summarize, is sort of like using your home equity as your primary checking account. So instead of running your
Right.
cash flow through a dumb checking account, which gives you no benefits, it's just a pass through, it's just a holding tank. You're running your cash flow through the home equity of your primary residence in this example, so that all of your capital is now working for you 24/7, paying down your home equity loan and growing the equity that's available to you in your house. And it's a two-way street. With a mortgage, it's a one-way street. If you pay down your mortgage, well, that's great, but then you lose access to all that money you paid in. Whereas here, as money comes in, it's a two-way street. You can pull that money back out because it's a home equity line of credit. It's not
Yeah.
a mortgage. It's not a one-way loan. It's a two-way line of credit. So we can put money in, pull money out as needed and as makes sense for us. So it's a much more efficient cash flow management tool. So it can be
Yeah,
used as just a way to pay down your house more efficiently, more effectively.
certainly.
That can be one use of it. But with velocity banking, we like talking also about more advanced use cases. So if you are a real estate investor, as an example, this could be one way to make a better, more strategic, more liquid use of the equity in one of your investment properties, or even use the equity in your primary residence to purchase an investment property. So, Greg, I know you work a lot with real estate investors. Let's talk a little bit about some of those more advanced scenarios where, let's say, I'm comfortable with where I am with my primary residence. I'm not particularly interested in paying it off super fast, but I am looking to say, hey, how can I make strategic use of the equity I have either in my primary residence or maybe an investment property?
Sure. Yeah. Yeah, it's one of the greatest tools that we have when you can actually utilize your primary to purchase cash flowing assets like rental properties, right? So we have dozens of clients that have utilized this. Harrison and I have both utilized this personally, where we have an all-in-one loan on our primary residence. The difference between the value and what we owe allows us to tap into liquid equity. And for example, for me, I've utilized my all-in-one loan for a down payment on a rental property. The rental property then gets a tenant into it. That tenant pays more than the 30-year fixed mortgage that I take out on it. And then I use my income to pay down what I expended for the down payment and then rinse and repeat. And so it's really one of the biggest issues of scale that we see with real estate investors is access to capital. And it's typically not access to capital on the loan side, it's access to capital for the down payment side to get in front of it. And so the all-in-one loan allows you to do that.
It actually really allows for individuals to reshift the way that their mind works. Now, I was talking to this couple a couple weeks ago, and they were going through it. They're, like, why do we do a 30? Well, we want to do a 30 mortgage. Why would we want to do this all in one loan? And after we kind of started chatting with them and they started understanding that, oh, if they went into this all in one loan, they'd have their home paid off in 4 years. Now they could extend that to 6 years and actually started pulling and intended to use money for their financial advisor and start sticking it into other investments. But after I realized that the family got it when the wife said, so wait, are you telling me that if I was to buy a purse for $10,000 at today's interest rate, that really it's more like me paying $61 a month for a $10,000 purse? And at that point, I knew that the husband kind of got mad at me. And it was kind of like a really funny way for them to say, okay, so I really just need to spend $61 a month to get this really nice purse. And I said, listen, that's your choice. I don't need to be in the middle of this argument. And then I apologized to him profusely after they left.
Yeah, I love it when in my line of work, I oftentimes get to play unpaid marriage counselor. That's always a lot of fun.
Yeah.
You're talking finances, and oftentimes the two spouses are not exactly on the same page, and I get to be caught in the middle of a really fun conversation and try to be objective and just kind of advise. But yeah, 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 it's interesting. So, Greg, you're talking about kind of using, in this example, the equity you have available to you in your primary residence to make a down payment on a rental property. So I'm going to buy, let's say, like a long-term buy and hold rental property, very safe, and
Mhm.
I'm going to cash flow, right?
Sure.
So I pull, let's say, $50,000 from my primary residence. That goes into the down payment. So on this investment property, I probably have a standard 30-year mortgage, but I am using my first lien HELOC to make the down payment. Or could I, conversely, I mean, I guess I could, in theory, have an all-in-one loan in both, but it would be a question of which one am I cash flowing. I could, in theory, cash flow both, right? So let's talk about that a little bit
Correct.
because I think you could have multiple all-in-one loans, and some people do. In fact, I think some of the people in this room do. But you're probably only going to be practicing velocity banking with one of them primarily, right? So you would, in this example, you would pull the equity from your primary residence to let's just say, to keep it simple, we're going to make a down payment and use a 30-year mortgage to buy this new investment property, okay? And then we just run our cash flow through our primary residence like normal. So that gets
Mhm.
paid, that's 50,000 gets paid down as our income comes in, right? Over here, we still have a 30-year mortgage, right?
Mhm.
And we're hopefully collecting rental income, which then we're feeding back into our all-in-one loan over here, right?
Yep.
You wanna talk a little bit more about the mechanics of it after we bought the property?
Sure. Sure. So you want to think about it in terms of kind of a longer scale, longer time horizon for your plan, right? Ideally, and on average, Harrison, correct me if I'm wrong here, but on average, nationally, all in one loans that CMG originates pay down their 30-year fixed loan in between 9 and 11 years. Now, that's an average. We have folks that are faster, some folks are a little bit slower, but we tend to expedite the payoff of the primary residence significantly when compared to a 30-year fixed mortgage. So for me, if I've spent some of my all in one equity to put a down payment on a cash flowing rental property, it's still my intention to utilize my income and now my positive cash flow from that rental property to pay down my primary residence. Because once I have enough available equity in my primary residence all in one loan, if I decide to, I can then turn around, pay off the 30-year fixed mortgage on that rental property and continue to pay down debt, right? I could utilize that same equity, that same all in one to expedite my debt pay down in a number of different kind of phases, right? In fact, my mom and her husband refinanced to an all in one on their primary, use that all in one to pay off her rental property, and then use their income to pay both down. And now are walking into retirement this year with two houses totally paid off. And one of them was a cash flow rent.
That's
One of
amazing.
the cool things that I feel like sometimes people go, well, that's just such a long time horizon. So if we get granular for a second, if you have a rental property and your rent is due on the first, you don't have, and it's in a 30-year mortgage, you don't have to make your mortgage payment until the 15th. So you could make your mortgage payment on the 14th of that month. And for those 14 days, you've essentially taken the tenant's money, that $2,500 in rent on your $2,200 a month mortgage payment. And you've been able to take advantage of that $2,500 sitting against your mortgage balance for 50% of the month. So essentially, that's like taking advantage of that's like having a mortgage balance that is $15,000 less in calculated interest as though it's $15,000 less. I just essentially took 25,000, multiplied it, or sorry, 2,500, multiplied it by 12, and took it as 50% of the month. So you're actually able to really see reduction in interest in your mortgage balance, even by just waiting to spend that payment.
Right, right. So when we're doing velocity banking, if you're doing standard banking and you're using a checking account, your money just sits in a checking
Okay.
account, right? So in this example, you have a mortgage payment due on the 15th, rental income comes in on the first, and then it just sits there for 15 days and it does nothing for you. And then you pay the mortgage. In this example, your money sits in your HELOC, which means it's in velocity. It's actually working for you. So for those 15 days, it's pushing down the principal balance that you owe by $2,500 if that's the rental income you're getting, right? And so you just reduced your out of pocket interest payment. And without changing anything you're doing, you've now reduced your out of pocket interest costs and you've reduced the amount of time it will take you to pay down that loan, right? And if you're a real estate investor, this is how you can start kind of like we talked about, sort of recycling your money in this ever increasing cycle. So money income comes into your all-in-one loan, pays down your mortgage, pays down your HELOC, right? And once you've freed up enough equity and you find a deal, then money comes out and flows into that deal, which then creates cash flow that you then cycle back into your primary residence all-in-one loan, right? That's one of the ways in which you can use it. And to complicate things even further, I love bringing in infinite banking, where you can also be building and running your cash flow through specially designed whole life insurance policies where you grow cash value. And there are advantages to both, right? So you'll have your all in one loan. One of the great advantages to the all in one loan is that you free up a lot of equity, free up a lot of liquidity right from the get go, right?
Mhm.
So you might have the average person might have $200,000 in equity in their house, right? That they can then free up with an all-in-one loan, right?
Exactly.
Whereas with whole life, it's kind of the opposite. You lose liquidity when you get started, right? You make your first premium payment into a whole life policy, it's going to take you multiple years to really get through those original mortality costs and really become cash flow positive, right?
Exactly.
So, what I love about combining the two is if you combine the all in one loan with a whole life policy, you don't lose any liquidity because the liquidity you lose by purchasing that whole life policy is more than made up for by the liquidity that's freed up in the all in
Hmm.
one loan. And now you have two strategic pools of liquidity you can draw from. If you're a real estate investor, you can use either one, and it kind of just depends on what's most advantageous for you, right? One of the
Exactly.
advantages of the whole life policy is there's no theoretical limit to how much capital you can build in it. In your primary residence, the limit is, well, what's the value of your
Yeah.
house, right? Once you paid that off completely, there's no more room, right? Whereas the whole life policy, you can keep feeding it, and that compound interest can keep growing from now until the day you die.
Yeah.
So we talked about using an all-in-one loan on your primary residence. Let's talk about using it on an investment property. So let's talk about using the all-in-one loan to actually purchase an investment property. Greg, what would that look like, and what would be the advantages to doing that?
Sure. So the guidelines for the all-in-one on an investment property are not all that different. Your leverage is a little bit lower. You get more money lent to you on an all-in-one loan on a primary residence than you do on an investment property. So you have lower leverage, higher down payment. But if you were to think about running your cash flow, let's assume that you're running your cash flow through your primary residence still, but you're buying an investment property. You still really like the idea of the all-in-one. So you want to use the all-in-one to buy an investment property. One of the nice things you could do is you can effectively treat that investment property like you put a silo on it with that all. So your renter pays you rent. Let's assume that rent is several $100s more than your mortgage. It's your cash flow positive, which is why you're buying a rental property. You can just feed that rent into the checking account in that investment property and pay down the principal on that investment property so that you have a paid off rental property much, much faster than if you use a 30-year term loan. And the nice thing is that because you're creating equity from the rent paid to you by your tenants, if something happens, you need a new hot water heater, you have to replace a window, roof, etc., you've built in your cash reserves for that property, simply the equity of the all-in-one loan. So you would draw that out of your all-in-one loan in order to fix or do whatever you need to do for your CapEx expenditures for the property right from the account that you're using the entire time. So that would be the
Yeah,
way that I would look at it in terms of utilizing it on an investment property. You keep it in its own silo.
right. And the liquidity is phenomenal. I say it's kind of like a Burr strategy, but without the need to refinance, right? Because you're as you pay money into the property, you're building up the equity in the property, and that equity is always available to you. So you can always pull it right back out. There's no need to refinance. You don't have to do a cash out refi to pull the equity out of that property. So you
Correct.
have that amazing liquidity available to you. Um, Now, one thing I wanted to bring up, Harrison or Greg, 2006. So this is a great conversation because one of the things I get is, oh no, the bank could freeze my HELOC. The bank could
Right.
freeze everything, right? So you started your product pretty much at the worst possible time because then in
Or the best,
2008, the
depending on
housing
who.
market yeah, the housing market crashed. Were any of your all-in-one loans frozen when that happened?
So not that I've seen it, not that they told us. So essentially, that's kind of the claim to fame was that there was no line that was frozen. Now, I mean that with an asterisk around it. There is a period of time in which somebody's not making deposits in the account for 12 months and they're seeing that money's coming out, nothing's going in. There's possibility, like any bank should be doing to make sure that they're protecting their risk, saying, hey, reach out to us. We need to know what's going on. By all means, we want to have a conversation. It is a person to a person at the end of the day. Instead of saying, hey, you're closed, shut off. Sorry, get out of it. It's truly like, hey, we haven't seen any money come into the account. We see money coming out. Can we hear about your situation? We want to understand what's going on. And so that is one of the positive items that we talk to people about is that no account was shortened or curtailed or anything along those lines during that time frame, and it actually had allowed for individuals to still make other payments on other things during that time frame. So they never actually saw the level of loss that certain individuals were able to that other individuals saw during that time frame.
Right, right. Andy Brown talked about that when he came on my show about how he personally
Mhm.
had one, an all-in-one loan on his house, and it helped him get through that time frame because he was in the mortgage business, and so he wasn't making a lot of money. It was a tough time to
Yes.
be in the mortgage business, and so that gave him the liquidity to get through that time frame. Because I think that shows the difference between a first position HELOC and a second position HELOC, because a
Exactly.
lot of those second position HELOCs were indeed frozen. And a lot of people who had been making payments or who had no balance at all saw theirs like frozen, shut off, whatever. But a first position HELOC, especially one that's in conjunction with velocity banking, puts the bank in a better position. So they're not as worried about needing to knee jerk freeze a line if something bad happens, right? And then I think, quite frankly, also because of the way this works, the quality of the borrower is different. And
Substantial.
notice I said different. It's not like they have to have a super higher credit score necessarily. It's more about the education, right? Because with the all-in-one loan, you're typically wanting to bring someone in through an ambassador like myself to really educate them on, hey, this is not just a product. This is a whole strategy. Because we can give you the all-in-one loan, but if you don't really understand the velocity banking strategy that goes with it, you're not going to make a very good use of it, right? If these were sold
Certainly.
the way a standard HELOC was sold, it'd be a disaster because then people would just use it like a
Oh,
credit
people would
card,
mess it
pull
up.
the full
Totally.
amount. Yeah, yeah,
Yeah.
yeah. Greg, do you have, maybe we don't have to go into like specific numbers or anything, but do you have some examples of real estate investors that you've worked with and how they have successfully used the all-in-one loan on their properties in various ways?
Absolutely. Yes. Yeah. I mean, like the example I gave with my mom, it's the more you can consolidate debt to ultimately expand either your number of doors or your monthly cash flow, the all-in-one can support you either way, right? If you're trying to expand your number of doors, it gives you access to capital for that initial down payment to get into a cash flowing rental. The other thing I would say, Logan, that I think most investors that have been in the real estate investment sphere for a while start to realize that the end goal, once you have your number of doors and you're starting to get to a place where you're consolidating and paying down debt, the end goal is to be a lender, right? To hold paper on real estate investments, because then you don't have to worry about toilets, trash, and tenants. And the nice thing about the all-in-one is, let's say you get an all-in-one today, and over the next 10 years, you get, call it 10 doors, you get one property per year. Run it forward another 10 years. You aggressively use your income to pay down your all-in-one and then started the process of paying off your rentals. And as this goes on, your cash flow snowballs and your debt pay down snowballs as well. Pretty soon, you're going to have 10 rentals that are paid off that are cash flowing. You have a primary residence with access to capital that you currently don't have anything to do with because you've raised your door. Like, well, at that point, you start giving out private notes. And there's a group of real estate investors, there's a large group that want to buy dilapidated properties that guys like Harrison and I can't finance in the conventional. We can't write loans on properties that are too beat up. But a real estate investor wants to take that discounted, dilapidated property, fix it up, and then refinance out of it to pay off their private or hard money lenders. Hard money lenders are charging 15 to 18%. But if you can get it with a private money person, a friend, a family member, someone you know personally, you might be able to get 12%, 13%. The risk for the lender, once you know a couple of things, you know who you're working with, you get a promissory note, you get liened against the property so that if something goes wrong, you can actually acquire the property yourself. The risk that you take on the lender as a lender is pretty reasonable. And you can make 12% on your money in a short amount of time. A lot of these exits are within 6 months. So if we're looking not only at the immediate access to buying more properties, but we're looking down the road at the availability of like potentially being a bank, which is be your own bank, right? Part of the velocity banking strategy, right? Being a bank to
Yeah.
other people, potentially,
Uh,
it
uh,
offers a huge amount of upside for the real estate investor.
And you
yeah.
create some arbitrage as well. I mean, if you're borrowing it, you're from your all-in-one at, let's say, 7.5, and you're charging 12 or 13, you're making that spread at the end of the
Mhm.
day without taking on, like Greg said, any of that inherent risk of, oh, the contractor didn't show up or they screwed this, they cut this corner and whatnot. But that's kind of the place that you want to start is, one of the examples again, and I hate to use us as a use case, but Greg and I found a property over in Pennsylvania, part of his real estate group that he works with. They had some decent opportunities out there, and we bought this dilapidated property essentially for 60 some odd $1,000. We put in about $40,000 worth of work. It was all done with our all in one. So cash in the seller's eyes and in the contractor's eyes. We ended up getting the property appraised and at that same time got it set up for Section 8 rental housing. We pulled the money back out, paid ourselves off, and essentially brought in a few $1,000s, but the property's cash flowing something like $500 a month. So if we think about our cash on cash return, if it's making 6 grand in deposits extra a year and it cost us about $4,000 above and beyond in closing costs or what have you, then our rate of return is drastically higher than if we were to have done that with 25% down and this and cash out of our pocket. It gets a little more complicated at that point. So you can make things easy too.
Right, right. I think with both velocity banking and infinite banking, what you're doing is you're giving your dollars more than one job. So
Yes.
let's say you have $100,000 mortgage and you have $100,000 in savings, right? In that standard conventional method, you have two options. Either you can pay off the mortgage or you can have the liquidity, right? If you take
Agree.
your $100,000 and pay off the mortgage, now you've paid it off, but you have no liquidity. Your $100,000 is gone, right? If you have, let's say, $100,000 that you owe in a first lien HELOC and you have $100,000 in savings, you can get both. Now you move that $100,000 of savings into your all in one loan. Okay. So you paid it off, but you still have access to your 100,000. It's a two-way street. It's in the line of credit. And infinite banking with whole life insurance works the same way, right? Jason Lowe, the number one infinite banking guy in Canada, people will come to him all proud and say, "Hey, I paid off my mortgage." And he says, "Well, that's great. But now who has your money?" Right?
Yeah.
It's kind of like, okay, you paid off that mortgage, but where's your money now? You don't have access to it anymore, right? So you can also, as an example, build up the liquidity in a whole life insurance policy, $100,000 worth, then take out $100,000 policy loan and pay off your mortgage, your student loan, your credit
Mhm.
cards, whatever it is, right? And you didn't lose access to the money because $100,000 is still in the cash value of your policy. You didn't spend it, you just borrowed against it, right?
Mhm.
And
Still
so
accruing
whole
interest
life,
at that $20,000 amount.
right? And a whole life works similarly in that it's like a line of credit. It's a two-way street, right? You can pay money in, pull money out, pay money in, pull money out. And so that $100,000 policy loan, as my income comes in, I can pay down that loan and I'm just freeing up the liquidity again, right? Meanwhile, the full principal balance keeps earning for me, right? And of course, one of the advantages of infinite banking over velocity banking is there's no risk because unlike a house, your whole life policy is guaranteed to go up in value, right? It's hopefully not likely, but it is possible your house could go down in value. It's happened, right? It's happened in the past, especially if you're talking about a rental property. It's possible, right?
Yeah.
Um, and then it's all tax free and there's no bank involved, right? So when I take out a policy loan, I'm my own banker. I decide what the repayment terms are, right? So you want to have both, right? I think the advantage to the all-in-one loan is the liquidity, right? You're not sacrificing any liquidity when you take out an all-in-one loan, and you're probably reducing what is your largest debt, right? And there's other advantages as well, but that's why I like both in conjunction, right? I think it becomes if you have one, it's great. If you have two, it's a 1 + 1 = 3 conversation, right? They become mutually self-supporting. You can refinance from one to the other as it makes sense for you, depending on where interest rates are, depending on how much you value liquidity versus control versus out-of-pocket interest costs. And it becomes a great symbiotic system between those two. And that's something I hope to create a lot more content around because it's such a fun system
Yeah.
once you have that in place. So Harrison or Greg, this has been a lot of fun, and I'm sure we'll talk about this some more. I want to go through some real life use cases and nerd out on all the details, but this was just kind of an introductory
Sure.
conversation. Is there anything you guys want to leave our audience with in closing?
I mean, not necessarily. No, I mean the majority would really be if you don't know how or why something works, there's ways to find out. Obviously, you have phenomenal educational content. We are more than able to assist and help people learning about it. Just because it seems weird doesn't mean that it doesn't make sense. I mean, I'm sure that the first time anyone hears about the infinite banking or the velocity banking. It's, oh, that's, hoopla. We're not going to mess with that. But by no means is this product the right product for everybody. Um, it will make sense as you continue to build your, profile along the lines of what you're earning and what you're saving. And if you have your game plan really dialed in, if you go, I don't really know what I want to do. I don't know what my 5-year goal is, but I make good money and I save good money. Okay, possible it could make sense, but you can get yourself into a lot of trouble. So talk to somebody. Certainly, we can include financial advisors or whomever on the conversation should that need to be done, because education is the number one hurdle on all of this.
Yep. Yep. So financial discipline and a willingness to learn. Those are really the two keys.
Yeah.
If you got those two, we can, even if you're not in the cash flow position to do it now, we can probably, and you probably will, get there, which is why I think real estate investors can be great candidates because they tend to get it,
Yeah.
and they tend to be willing to learn. Surprisingly, oftentimes the people who are the least willing to learn are the people who know the least. And the people who are most willing to
Yeah.
learn are the people who know the most. Surprising how that
Right.
Yeah.
works. Well, thanks so much for your time, Harrison and
Thank
Greg.
you.
Really appreciate it, and we'll look forward to the next one.
Awesome. Thank you so much,
Sounds
Logan.
good.